Okay, let's begin looking at derivatives. So chapter 6 questions in derivatives. Some find these the toughest of the section. Others absolutely love it. It's not calculation heavy. It's just many of you may not have come across derivatives in the past, and they may seem a little bit abstract. But from where the syllabus comes across and the exam comes across, they're fairly straightforward, more definition-like questions. Okay, in this section, we're going to look at what derivatives are, what's the definition, what are the types. We then dig a little bit deeper into futures, but not very deep. Options, once again, not that deep, more definition, a little bit of an example, and swaps. And then we look at the markets and the exchanges where derivatives operate. Okay, so firstly, derivative, what's the textbook definition? It's a financial instrument. Okay, so it's a financial instrument. It's not a security, it's an instrument, okay, whose price is derived or based on the price of another asset known as the underlying. It's based off some form of security. So, for example, something based on the price of a share. Well, we've come across shares. Something based on the price of a bond. We've come across bonds. On commodities, on real estate, okay? The underlying could be anything. Financial asset, commodity, currency, index like S&P 500, okay? Shares, bonds, commodities, any metals, any other commodities can be there as well. And the origins of these derivatives can actually be traced back to the agricultural markets. Farmers needed a way to guard against price fluctuations, and hence we may hear the term hedging. Okay, so farmers need to hedge the price of something because they are spending time buying the crop, making sure that they're irrigating their produce to ensure that it sells. But what if by the time it's ready, the market price has fallen and they lose money on it? So when they are putting in their time, then they need to make sure that there is a locked-in price to sell, okay? So rather than have to fluctuate based on gluts of produce or merchants who might want to guard against shortages, they need to get involved in derivatives. That's where it started. It's gone a long way from there, and it's used for many other reasons, which we'll come across. And derivatives can be both. They could be exchange-traded or OTC. Exchange-traded is more regulated, more standardized. OTC tends to be more customized and slightly less regulated than the exchange-traded world. So derivatives has certain major uses or roles that they play in investments, in investment management, in the financial markets. Okay, one of the main uses, and back to that farmer example, is hedging. Okay, and hedging is supposed to reduce risk. Okay, so a farmer hedges their produce by locking in the price they're going to sell in the future. Okay. What about portfolio manager? Where a portfolio manager might want to hedge against the price of their portfolio, the value of their portfolio being reduced to adverse movements. This could be achieved by, in this case, selling futures contracts or buying put options or selling other options. And we'll come across options and what they are. You may also want to anticipate future cash flows and therefore use a derivative for that. A portfolio manager expects to receive a large cash inflow. It's not there yet. They can use derivatives to lock in the price to buy when that cash flow comes in. Okay? So that offset the risk that price will have risen by the time the cash flow is received. If they bought today, it's cheaper. If they wait a month, it may be more expensive. So they can lock in the price to buy. And again, you'll see more as we go through examples, but this is just main uses for derivatives. What else? They could be used to change asset allocation. What do I mean by asset allocation? I may have a portfolio which is 60-70% equity investments, shares, stocks, global, local, and 30-40% is bonds, is fixed income, bonds related, less risky. Okay? So what if I think over the next 3 months equity is really going to tank? I might change 30% of my allocation of equity and move that into fixed income, but just temporarily. And that asset allocation change, I can use derivatives to do so. I can use futures, swaps, you'll see. Okay? So these are used to take advantage of short-term directional movements, but changes my strategy as a portfolio manager. Okay? Another use is arbitrage. Arbitrage is risk-free profits. Okay, simultaneously buying and selling the same asset in two different markets. I buy it on one exchange, sell it on another. It's the same thing, but they're at two different prices. You want to make money, buy low, sell high. And you can do this with derivatives. Sometimes the derivative is made up of 2 or 3 different things. And if we buy those 2 or 3 different things and sell the derivative, then I'm not taking any risk because it's the same thing. But I might see some price difference. Okay? So arbitrage, just be familiar, it's risk-free profit by simultaneously doing the two opposite, buying and selling the same thing, but it's different markets or different ingredients that get to the same thing. And we save the biggest one till last. By far the biggest reason of use of derivatives for most things is speculation. You don't need to hold the asset. You don't need to hedge. I might think the S&P 500 is going up. Rather than buying 500 different companies in the right weightings, I would just buy a future on the S&P 500. I'll buy an option on the S&P 500. I'm speculating the price go up. I have no need for oil in the way it's traded in terms of barrels of oil. But I might think the price is going up and I'll buy a derivative on oil. I never have to see the oil, smell the oil, or feel the oil, but I can benefit from the price going up. And most derivatives take the form of forwards and futures, fairly similar. Forwards are over the counter and futures are exchange traded, worth noting. Forwards are OTC, futures are exchange traded. Okay. We then have options and swaps, and options and swaps, all of these we're going to go over in a bit more detail. Okay, options can be both exchange traded or OTC. Let's start off with futures. Quite a bit of information here. Just make sure you're taking the key points, understand what it is before you dig deeper into the examples. Okay, pause, rewind if needed. It can get a little bit more complex than some of the previous areas. A future is a legally binding agreement between a buyer and a seller. Straightforward so far. Every derivative needs a buyer and a seller. The buyer will agree to pay an amount for delivery of a quantity of an asset, pre-specified, at a date in the future. Okay? They don't just agree in a future or forward, they are obligated. They don't have a choice. They have to go through with this, contractually obliged. For example, I agree to pay £1.50 to buy a Vodafone share in 3 months' time. Which date? Let's pick a date in the future. Some date in December, let's say 15th of December. I will buy, let's say, 1,000 Vodafone shares. Each share will cost me £1.50. I have to go through with it. But I don't need to pay today. I've specified the asset, Vodafone share. I've specified the price, £1.50. I've specified the date, 15th of December. All that happens is the settlement, which will happen 3 months later. The seller is on the opposite side of the deal. The seller agrees to deliver the asset in exchange for that pre-specified amount on that pre-specified date. Every buyer needs a seller. Effectively, it's a forward sale, forward purchase, okay, sort of thing you might do. If you want to buy some real estate, you want to buy an apartment, you'll go to them and say, I want to buy this, the price is $400,000, you'll lock in that value. You pay a little deposit maybe. It's a little bit different because here it's not really the same deposit style, but you're locking in a price to buy. You have to go through with it. Okay? A buyer might agree with a seller to pay $50 per barrel for 1,000 barrels of crude oil in 3 months. The buyer might be an electricity generating company and wants to buy the oil, fix the price they're going to have to pay for oil, or an airline who wants to fix the price of jet fuel, okay, to use in its oil-fired power stations. And the seller might be an oil company wanting to fix the price they want to sell their oil production, their future oil production. So you see the buyers and sellers have met. And you don't need people who actually need this. You could have speculators that are trading as well. So it's actually a fairly liquid market, very liquid market. And the futures, they are exchange traded. They may trade on ICE in Europe, ICE Europe in London, or the CME, Chicago Mercantile Exchange in the US, big derivatives platform. And it's always standardized, okay? So there will be specific maturity dates, specific future dates, specific assets that are traded and quality of oil. Oil having a certain density and a certain level of what they call sweetness or sulfur content, okay? The quantity, one contract is 1,000 barrels of oil, that's pre-specified. That's when it's exchange traded. When it's OTC, it's much more customized. But futures are exchange traded, forwards are OTC. Certain terminology, well worth you picking up for this exam as well as for your careers. If you go long, you are buying or you are going to buy. Long is used for the position taken by the buyer, okay, or you're going to buy in the future. If you're short, the seller, you're short, you're selling or you're going to sell. If you open, that means you're starting a position, the initial trade. You could either buy or sell, but you're opening your position. So I buy 20 contracts of oil futures, 1,000 barrels per contract times 20. I'm going to buy that in 3 months' time. I buy the future today, but I'm going to get the oil and transact in 3 months' time. I've opened a position. I don't have to wait 3 months. Within 1 month, within a few days, I may close that position. You can close the derivative. You do equal and opposite. Same number of contracts, but instead of buying, you sell. So close when the delivery of the underlying asset happens. In reality, physical delivery will most times not happen because the buyer will close before the delivery date. I don't want the oil. What am I going to do with 20,000 barrels of oil? I'll close it before the delivery date. I just wanted to benefit from the price going up. Okay, into the world of options. Feel free to pause, take notes, okay, to pick these things up. In the forward and future, we saw that you were obligated. Here, you're not obligated. You have an option. You have a choice. An option gives the buyer the right, but not the obligation. You have a choice to buy or sell, different options, to buy, okay, an asset at a pre-agreed exercise price on or before a future date, between two specified dates. So you could either buy an asset or sell an asset, two different options. Okay? The seller, in exchange for the payment of a premium, grants the option to the buyer. Let's take a bit of an analogy. Let's take a step back. You go to that same real estate developer and they say, we've got a property here, $300,000 for this apartment. And they said, all you need today is pay a reservation fee of $5,000. You think, do you know what, that's a good idea. This might sell quickly. Let me reserve it for $5,000. Okay? So you reserve it. This gives you the right to buy that apartment for whatever, $300,000. But it's not ready yet. It's going to be ready in 6 months' time. In 6 months' time, maybe that apartment has gone through the roof. The price now is $500,000. You've got a contract where you can buy it at $300,000. You're going to do so. Maybe the price has fallen. There's so many in the market. This developer wasn't able to sell theirs. You gave $5,000 reservation price to buy it at $300,000. But in the market, they're available for $200,000 from the people who bought it and are trying to sell it. You're going to say, well, forget about that $5,000 I paid. I'm just going to go buy it in the market myself for $200,000. Similar story, not exactly the same, but similar. Here, the buyer pays a premium. The seller, the developer, gave them the chance, the option to buy it later at a fixed price. The buyer of the option had to pay this reservation price, this premium. The difference is this premium is non-refundable. In the case of the developer, you may have been able to use that $5,000 to offset against the purchase price. You can't do that in options. A call option is when the buyer has the right to buy the asset at an exercise price if they choose to. It's a choice. The seller has to go through with it. They're obligated if the buyer exercises. Okay? So a call option is when the buyer has the right to buy the asset. A put option is when the buyer has the right to sell. So we have two options here. Call, okay, is a right to buy, and put is a right to sell. Okay? A put option is when the buyer has the right to sell the underlying asset, at a pre-agreed exercise price. The seller, the put option, is obliged. Similar. The buyer has the choice. The seller has to go through with it if the buyer decides to exercise. The buyers of the options are the owners of the options. They're also referred to as the holders of the options, whereas the sellers are referred to as the writers. They sort of write the contract, they write it. Okay, the sellers of the option, they're short and we saw the term short the option. Their sale is also referred to as taking for the call or taking for the put. Okay, but be familiar with seller, with writer, buyer is a holder. And for this level, that's what you need to know. Yeah, deeper modules go into quite a bit more detail in options. But let's see an example. Okay. Suppose shares in Jersey PLC are trading at $3.24 and an investor, Frank, buys a $3.50 call. What is that $3.50? That's the exercise price, also known as the strike price. For 3 months, and Steve is the seller. Okay, so Frank can buy Jersey shares at $3.50 in 3 months. Let's see what happens. If Jersey shares in 3 months are below $3.50, what do you think Frank's going to do? Is he going to buy it at $3.50? Absolutely not. He's going to say, Steve, you keep the premium I gave you. Okay, we're going to abandon the option. We're not going to exercise. Steve keeps the premium and he walks to the bank with it. But let's say the shares increase considerably to $6. What will Frank do? He'll exercise the option. He can buy the shares at $3.50, even if he doesn't want them. Buy it at $3.50, sell it the next second at $6. Okay? So in this way, he can get the shares and then sell the shares or keep the shares. Or he can do a cash settled agreement. Okay? It's agreed up front. You don't decide this later on. The contract is agreed. And he gets the $2.50 difference. 6 minus 350. Remember, he did have to pay premium at the start for this option. You have to pay a premium. So he doesn't make $2.50 profit, he makes $2.50 less a little bit of premium. If Frank paid premium of 42 cents, okay, what's his maximum loss? His maximum loss is 42 cents because he can walk away from the option. And what level does Jersey PLC have to reach for Frank to make a profit? Well, he needs to make his 42 cents back. So $3.50 plus 42 cents, the break-even point is at $3.92. He's made back the 42 cents because the market's moved up by 42 cents. This is an example of a call option. Put options have different sort of thinking to it. Okay. What's the max gain or loss for Steve? Well, the most Steve on the other side of the deal, the seller of the option, the most he can make is the most Frank can lose. It's a zero-sum game. Frank loses 42 cents, then Steve will make 42 cents. That's the most Steve will ever make. You might feel bad for him, but he can make money even if the market doesn't move. And the loss depends on whether it's covered or if it's naked. Okay, naked would mean Steve has only sold this option. He doesn't actually own the shares. Covered would mean he owns the shares. Okay, if it's the latter, if it's naked, then the loss, potential loss, the max loss is a scary. Hopefully this puts you off going and trying and trading on these derivatives straight away. It's a scary, unlimited loss. Okay, brings us into another type of derivative, a swap. A swap is an agreement to exchange cash flows, but it's a periodic agreement, so you exchange cash flows periodically. One set of cash flows for another. It will be OTC, we don't see these exchange traded. Okay, they're negotiated between the parties. The most common is an interest rate swap. I pay you fixed, you pay me floating. I pay you fixed of 2%, you pay me LIBOR. We don't know what LIBOR is today, so we look at it 6 months' time. You pay me whatever that rate is, I pay you fixed 2%. And we're going to net them off. Then we do that 6 months later, and again 6 months later. And we do this for 5 years. So that would be a 5-year swap with semi-annual settlement. Okay? Exchange of interest payments. And these are usually used to hedge exposure to interest rates. Okay, if I believe interest rates are going to go up, I may do this, or if I believe interest rates are going down, I may do this to hedge or reduce my risk. The two cash flows are known as legs of the swap, and the amounts are calculated by reference to a notional amount, and the amounts are generally netted off. They're netted. I pay you 2%, let's say LIBOR was 2.2%, you pay me 2.2%, we net them off, you pay me 0.2%. You might ask 0.2% of what? Of a notional amount, an amount that doesn't change hands, it's used as a reference number. I'd very nicely have the 0.2% of $10 million. Thank you very much. Okay, so it's off a notional amount. And then we look at CDSs. Now CDSs, it stands for credit default swap. CDS, credit default swap. Bankers aren't great at naming things. It's not really a swap. It's a little bit more like an insurance. But let's have a look. Credit derivatives are instruments whose value depends on agreed credit events relating to a third party. For example, the change in a credit rating, the bankruptcy of a company filing for liquidation, okay? Or an increase in the company's cost of funding, cost of funds in the market, or other credit events. So it could be a default, a bankruptcy, a significant fall in the value, a restructure of the debt, in other words, changing the terms of the debt, or maybe the company was taken over and now the terms have changed. The purpose of the credit event is to enable the organization to protect itself, think insurance, against unwanted exposure by passing that on to someone else. So for example, let's say I hold a Microsoft bond. Now I like Microsoft, but let's say I hold a Microsoft bond. I'm a little bit worried that they're not doing too well from a credit point of view. They may maybe default or delay payments. What I say is, look, I like Microsoft. I like the bond I have. I'm getting a nice coupon. But I don't want the credit risk. So what I do is I buy a CDS, credit default swap, and it insures me against them defaulting. Or maybe I have that for an Argentinian government bond or another country's bond. And I pass that exposure to someone else. So a CDS is more contingent. It's more like an option. The party buying the credit protection makes periodic payments. In fact, we even call that a premium. But we call that a premium even in the insurance world. Maybe quarterly I pay or upfront, depends, maybe both. Okay. In return, the buyer receives compensation if a credit event is triggered. So they're not guaranteed to get a payment. Just like if you buy car insurance, you're not guaranteed to get a payout. Your car needs to go through an accident, maybe a theft, fire, certain events have to happen, and then you'll get a payout. So if the event is triggered, okay, then you will get a payout, just like insurance. Okay, we move to derivative markets. Derivative markets, financial instrument whose price is derived from an underlying asset. We said that earlier. We said it could be OTC, it could be exchange traded. Really important you know the difference for this exam. Simple marks in this chapter, but worth familiarizing yourself. Exchange traded is standardized, okay? Whereas OTC is more customized or bespoke, okay? So let's take the example or analogy of buying a suit, okay, or a nice dress. You could buy it off the rack, go to a shop, get the size that's there on the rack and buy it. That's like exchange traded. Or you could get it customized or tailor-made. You go to your tailor and it's made to measure. Okay? Exchange traded is standardized. The suit comes in certain sizes. You pick the size, if it doesn't fit you perfectly, you got to go get alterations. But you pick the sizes off the rack. Standardized, and then it's traded. But it's also very liquid. Because if you buy it from the store, you can return it. Try going to a tailor. They've just created it for you, made to measure. The next day you come back and say, I don't like this color. Can I have it in another color, please? They're not going to give you a refund. It's made to measure. But OTC is the largest market by value and number of contracts, because you can go to the tailor so many times and in many different varieties. It's negotiated and traded privately, like with the tailor, between parties without the use of an exchange. The bulk of trading takes place in Europe between investment banks. Exchange traded, going to the shop, off the rack, more standardized products, single stock and index derivatives, a future on a single stock, on the S&P 500 derivative. There's a central counterparty between the parties when you go exchange traded. In other words, you might do a trade with a future Lehman Brothers on an exchange. No worries, you're not facing them. You're facing the exchange, or more specifically, you're facing a central counterparty, a very safe body. You don't have to worry about who's on the other side of that deal. If you're buying, you don't have to worry about the seller. Whereas OTC, there is more what we would call counterparty risk. Okay? You have counterparty risk in the world of OTC. Exchange traded, it's much safer, and there's something called margining. Just overview for this exam. And these are examples. It's what I call a look and learn slide. Okay, examples of leading derivatives exchange, the Chicago Mercantile Exchange in the US. They trade interest rates, equities, currencies, commodities. It operates the CME, the CBOT, NYMEX. Many exchanges come under this, even the COMEX Derivatives Exchange. In the UK, we have ICE. ICE is actually owned by New York Stock Exchange now. Okay, in the US and the UK, they have energy products, and in the UK, ICE Europe, they have some interest rate equity, and individual equities is single stock equities. Okay, so derivatives on individual shares. Eurex is in Germany. They do bond futures and options, and the LME is the London Metal Exchange. It does what it says. It trades non-precious metals, copper, aluminium, tin, zinc, others. Okay, familiarize yourselves. It's look and learn. You'll forget it by the time I move on the next line, but know it for your exam. Simple questions, simple marks. Bit on pros and cons of derivatives. Why do they exist? What's the advantages? Well, they enable producers, the farmer, consumers, the buyer, the bakery who may buy wheat of goods to get certainty in price. Remember the oil example? We had an airline, or we had a refiner of oil. Okay, I think it was an energy company. And we also had the oil producer. Okay. So both of them wanted to fix in their price, lock in their price to achieve certainty of price and delivery in the future. It enables investors and portfolio managers to hedge, reduce risk from adverse price movements. Remember this term, hedge. Offers the ability to speculate, the biggest use of derivatives, on a wide range of assets. I don't have exposure to oil, but I might think the price is going up. Or let's say tin or copper. I don't need it in my day-to-day life in terms of buying big quantities of this, but I can trade it on the market. And I can make large bets on movements using geared, or in some of your countries, you may call that leveraged, okay, leveraged use of derivatives. What are the downsides? There are a lot of downsides. Don't jump onto a derivatives platform and lose all your money. Investors can lose their shorts. They can lose more than what they've initially put in, okay? Lose more than their initial. You paid a premium in an option, you could lose only your premium when it's an option. But if you went short an option, you received the premium, you could lose much more. In a future, you could lose much more. Derivatives market thrive on price volatility. That's the biggest driver of their price, meaning that professional skills and experience are required. In most countries, you cannot trade derivatives unless you have some professional experience. And in the OTC market, we mentioned there is counterparty risk. You're facing the next Lehman Brothers. Your trade may be up, you may be making money on paper, but the company goes bankrupt, they owe you a lot of money, you may not get it. Okay? And it requires attention to detail in terms of counterparty risk. Often they're big transactions, and it needs good legal documentation and collateral and what we call margining, a way to reduce your risk through margining. Okay? So that gives you a feel of sort of pros and cons. Well worth it for this exam just to know that overview.